So, first of all, I want to thank everybody for coming. I very much appreciate you being here. I even more appreciate your confidence in investing with me. I'm very humbled that you guys would do that. I don't know if a friend of mine came to me that I had known as a real estate guy and said, give me some money to manage, if I would have done it. So I'm really grateful for that. I want to, before we start, thank a couple people specifically. First, I want to thank Rob Bridge. Rob was my very first investor. In fact, before I had my license, he was demanding that I take his money. And when we set up the account, he was there when I didn't know how to set up the account, patiently waiting for me to figure it out. One of the first trades I made for him, I screwed up and made a $10,000 mistake, which was a short-term thing. It wasn't a big deal, but I had to rectify it. And I called him and said, I'm an idiot and I did this. And I said, why don't I put...
What did you say one more time?
So anyways, I put $10,000 in his account till the money could get settled up, and then he gave me the money back. But the point is, been very, very patient with me while I work through this. And Rob, I really do appreciate that. Thank you very much. Somebody else that I want to thank, I've known many of the people in this room for 20 years plus. One of the people in this room I've known for almost 40 years. And she was one of the good enough, she's manufactured an investor for me because my ex-wife Kim is here and she made my son Connor. And I really want to thank her for being here and for investing. But more importantly, I want to thank her husband, Ben. So it's not easy to have another man involved in raising your son. Ben has been the best stepfather Connor could have hoped for, and I appreciate it, and Connor loves him, and Connor appreciates it. So, and for Ben to allow his family's savings, a significant portion of them, to be invested with his wife's ex-husband, is pretty cool, right? Yeah. So to Ben and Kim, thank you very much. I appreciate it for everything. So now I want to get started with the presentation. As many of you know, everything that I do is based on Warren Buffett and what Warren Buffett teaches. For those of you who don't know, Warren Buffett is recognized as really sort of the gold standard of money investing. He's respected not only for his spectacular returns on investment. If you'd invested $14 in Berkshire Hathaway in 1965, it'd be worth $560,000 roughly today. He's done actually even better than that because he started in 1955 with his partnerships. And the model that he used for his partnerships is exactly the model that I've modeled this after. He started with 9 investors and $100,000. And I'm starting with, at the end of the first year, 29 investors and $3.2 million. So obviously I'm way better than Warren, right?
Yeah, baby.
So what I'm going to talk about now is sort of just a lesson that Warren has taught on the importance and the power of compounding. So one of the great things about Warren is he's very intent on sharing everything that he's learned about investing. And he's written these annual reports that you can all read. They're 30 or 40 pages long. They're written to the level of a layman, and they're spectacular. So I would encourage any of you, can get them all online, and I would encourage you to do that. But this is an excerpt from a letter he wrote to his partners, very much like I have you guys as partners, in 1965. So in 1626, there was a Dutch explorer named Peter Minuit. And Peter Minuit had found this island in the eastern seaboard that he wanted to acquire as a base for the Dutch to start a colony. And so he sat down with the Indians. We believe it was the Algonquin Indians, but we're not sure, but that's who we're going with for this story. He sat down with the Indians, and he negotiated that he would buy this island for a box of trinkets and beads, and the value of those was generally recognized to be about $24. And so he sat down, they negotiate the deal for this island. Here's a picture of Peter. That island that he bought turned out to be Manhattan. So he bought Manhattan for $24, and most people think that, generally speaking, that may be the greatest real estate investment of all time. But that's not really where the story ends. Because what people don't realize is that the Indians, the son of the chief, was an investor. And he invested just like Warren does. And he invested the money very conservatively. He sold the beads. He went down to Wall Street in 1626 and he bought some stock. And he's invested the money ever since. So before I talk to you about his performance, I should give you a little sense about some things that happen with investing. There's something generally in investing called the rule of 72. And the rule of 72 goes like this. If you take the interest you return and the return on investment, and you multiply it times the number of years of the investment, when the product of that multiplication works out to be 72, you just doubled your money. So to make it easy, if you get 7.2% return for 10 years, you double your money. If you get 15% for 4.8 years, again, you double your money. And 24% for 3 years, you double your money. So this Indian invested the money very, very conservatively, and he was only able to get 7.2%. So 7.2%, he doubled his money, and it doubles every 10 years. So in 1636, it was gone from $24 to $48, and on and on and on. Well, if you're doubling your money every 10 years, in a century you have 10 doubles. So at the end of a century, you've got 2 to the 10th. And for those of you who are good at math, you know that that's 1,024. So we'll round down, and we'll say it's basically 1,000 times your investment. So the money that you invested at 7.2% in 100 years, we'll round it down and we'll say $10. $10 becomes $10,000. And the Indians have invested that way consistently since then. So in 1726, it had been 100 years, and they had 24,000. By 1826, they had 24 million. By 1926, they had 24 billion. And by 2026, in just a couple of years, they'll have $24 trillion. Who got the better deal? The guy who sold the real estate or the guy who took the $24 and invested it very conservatively for a very long period of time? Now, let me put $24 into context for you. The value of all of the real estate in Manhattan today is roughly computed to be about $2.8 trillion. The value of all of the farmland in America is computed to be about $3.2 trillion. All of the money in all of the banks and all of your bank accounts in America is about $2.26 trillion. And all of the money in the world, in all of the banks for all of the countries, is about $48 trillion. And so what you can see here is Albert Einstein called compounding this the eighth wonder of the world. If you take a small amount of money and you invest it conservatively and you wait patiently, you can do really, really great things with your investments. And so that's what I'm trying to do for you guys. I'm trying to be your chief compounding officer, right? My job is to help, is because you don't have the time, the energy, the inclination, the interest, or maybe the patience to find these great companies, you're trusting me to do it. And I take it very seriously. It's also something I really enjoy doing. I'm having a great time. This is way more fun than real estate for me. It's total nerdsville, I get it, but for me, it's really fun. My job is to focus on finding and researching great companies. That's all I do. I just get up in the morning and I come up with a company and I look at it and I say, is this a good company or not? If I think it's a good company, I do more research. If I don't think it's a good company, I ignore it and go to the next one. It's really that simple. And when I find great companies, I just research them till I find one that's cheap enough, and then that's when we buy it. My second job, which is the harder job by far, is my job is to ignore the noise. I don't care what the stock market's doing. I'm just trying to find great companies. If I find Walmart today, what Walmart was in 1970, if I promised you this company was Walmart, would we care if there's a recession? Would we care what happens to the price of oil? Would we care if there's we wouldn't care, because we know that Walmart is going to be great in 30 or 40 years. There's going to be ups and downs, but in the long run, we're going to do great. And so that's really what I'm trying to do. And the hard part is to not worry about, hey, interest rates went up 1/4 point today, and so the stock's down. Or the Fed's going to lower interest rates, so the stock's up. Believe me, Walmart, it just doesn't matter. Berkshire Hathaway, Walmart, Boeing, these companies that are great companies that manufacture solid products or that provide great services at good prices, in the long run, they're going to do fine. What we have to do is have the patience to wait. And the problem is, when the market tells you that you're wrong by dropping the price of a stock by 20%, you start going, maybe I was wrong. And you have to ignore that. So the next thing, I have to have the patience and the confidence to mostly do nothing. I don't trade stocks every day. I don't trade stocks every week. I don't trade stocks every month. I can go several months without buying or selling a stock. Why? Because I don't think anything's happening with my company. So take Mercedes. We own stock in Mercedes-Benz. Some of you have heard of it. They make cars, right? They make 2 million cars a year. There is no question they're the best at manufacturing cars. Maybe you like BMWs more, maybe you like Porsches more, but nobody can argue that there's anyone better than Mercedes. There's people as good, but nobody better. They make 2 million cars a year all around the world. They've got a great reputation. They spend $10 million a year on R&D. No one's catching them. No one's passing them. By the way, they're one of the top 10 manufacturers now of electric cars. They've stopped making, they're stopped research on internal combustion engines, and now they're only making electric engines going forward. It's a great company. Are you really telling me something's going to happen between 9:15 and 9:30 on a Wednesday afternoon or Wednesday morning that's going to materially change the value of Mercedes? I mean, what could it even be, right? But the market is going to tell you, hey, that stock's up 2% this morning. Oh, well, we should look at it. You need to ignore it. You need to just wait. Now, that's not to say I ignore the stock. I read every article written every day about every company we own. Most of our companies, there's nothing written, and most of the stuff that's written is garbage. But if it's out there and it's information, I'm studying it. But again, the goal is mostly to do nothing, which is the opposite of what your inclination is. And we'll go through some of the results we've had in a monthly period, but when your stocks are down, when I'm managing my friend's money, and I'm gonna go and hang out with Brady and watch football, and I know he's gonna say, James, you've been down 12% in the last 3 months.
Oh, very gentle.
Very polite, but he's like, what the hell? The point is, don't think that doesn't grind on me. It does. But you just have to say, look, I know Mercedes is down 20% since we bought it. They made 2% more cars than they made last year. The cars aren't garbage. We're going to be fine. So that's my role, and that's what I'm doing for you guys, is those 4 things. I'm focusing on compounding in the long term. I'm focusing on finding and researching great companies. I'm trying to ignore the noise, and I'm having the patience to mostly do nothing. So let's talk about the results for 2023. So the results that we're doing are based on my portfolio. All of your money is invested substantially the same way mine is, but you all joined at different times. And so if you joined in March, you'll have different results than if you joined in January, but I need some standard that I can use year in and year out going forward. And so I use my portfolio as the basis for this. On January 1st, I had about $725,000 in that account. Your results will vary from mine based on when you joined and based on if you've withdrawn or inserted money in the interim, because that'll change the mix-up of your balance. But in the long run, the longer you're invested with me, the more your results will mirror what my results are. So for 2023, we were up 24.52%.
Good job, man. Nice job.
Thank you. Appreciate that.
Not a great market.
Yeah, basically the market was up that much, and I just copied it. And I'm only being a little facetious. So my first goal is not to lose our money, right? It's hard to compound and get rich if we're losing money. So I'm invested in very conservative things. And so the first goal, we didn't lose money. Congratulations to us, pat ourselves on the back. The second goal is we want to outpace inflation. If inflation's 10% and I make you 8%, I didn't make you any money this year, you lost 2% of real wealth. So we want to make sure we're outpacing inflation. So when you type in Google what was inflation for 2023, they'll tell you it was 3.4%. That's actually not right. It probably was slightly higher than that. I'm not convinced that the government's not cooking the books on that. Democrats want inflation rate down so they get reelected. But whether it's 5 or 6 or 7% doesn't matter from the standpoint of we're beating inflation and thus creating real net wealth for ourselves. The third goal, and the way you should be measuring my performance, is whether or not I'm beating the S&P 500. So the S&P 500, for those of you who don't understand, is 500 of the largest companies in America that are selected as they're getting bigger, and then once they're on, they stay on the list as they grow. And that's the method that hedge funds and money managers are typically measured against. And the logic there is that you're not paying the S&P 500 a fee, and you are paying me a fee. And so if you could just buy the S&P 500 and perform at X, I need to outperform the S&P 500 to be creating value for you. And my goal and job is not just to be helping you compound your money and maybe protecting you from some of the mistakes you might make with your own money, but it's to outperform the S&P 500. So the S&P 500 was up 24.23%. I was up 24.32%. So I marginally outpaced the S&P 500 this year, but frankly, not by very much. Now, part of that is because the S&P 500 just performed so well. We're going to talk about how I've outperformed the S&P 500 over the longer time frames in a second. But before I do that, I have to admit something. So hedge funds want to be measured by the S&P 500 because hedge funds care about hedge funds, not their clients. Warren Buffett says that's not a good enough measure. What you need to measure yourself with is not just the S&P 500, but the S&P 500, including all total returns, which means including dividends. So the margin's a little bit higher. So when Warren tells you he's beating the S&P, when he's beating the S&P 500, Warren's using that metric. And because everything I'm doing is trying to copy Warren, I use the same metric. And so that number is 26.29%. And so I actually fell a little bit short of beating the S&P 500 for the entire year, which I know is not fun, but that's the way the numbers went. So this year, these are the results on a monthly basis. You can see we had good months and bad months. We beat the S&P 500 about 6 months of the year. Actually, 1, 2, 3. We beat the S&P 500 6 months during the year. They beat us 6 months. We were positive 6 months. We lost money 6 months. We actually had 3 months, August, September, and October, where we were down about 12%. The last 2 months of the year, we were up 20%. One of the things I want you to consider here is that if you look at the stocks market every day, you'll see a roller coaster. You'll see it just goes like this. If you look at it every month or every quarter or every year, it's just a train ride. It's just a smooth train ride. If you worry about, because if you look at all these gyrations that happened, and then you realize, well, God, if you look at this, it kind of looks like we didn't do that great. And then you say, somehow we were up 20% at the end of the year. So kind of the ups are a little higher than the downs are down, and it all works out. The next thing I want you to look at is it depended on when you joined. So this looks at if you joined in January, how did you perform since then? If you joined in April, how did you perform since April? And then how did you do relative to the S&P 500? So what's interesting here is the S&P 500, if you joined in January, I'm down to the S&P 500 for 1.77%. And if you joined in June, I actually beat, your results show that I beat the S&P 500 by 6%. So what you really see is the first 4 months of the year, we took a bit of a beating to the S&P 500, and for the last 8 months, we've outperformed it. The good news is no matter when you joined, you're up at least 8%. The other thing is these are not annualized numbers. So if you joined in August and you're up 8%, it's been about 6 months. Annualized, that'd be about a 16% return. And you would have beat the S&P 500, which would have been an annualized return of about 8%. So the longer you're with me, in theory, hopefully the better we'll do. And let's look at those numbers. So this is how I've performed with my portfolio using my exact same method over the last 4 years. So in a 12-month period, I'm up 24%. I lost the S&P 500 by 1.77%. Over a 24-month period, the S&P 500 is only up 1.69%. I'm up 10%, so I beat it by 9% over 2 years. Over 3 years, I beat it by 5.79%. And over 4 years, I beat it by 10.7%. So the longer we're investing, the better our results are getting. Some of this is just luck. Another thing that if you do any research into the performance of the S&P 500 this year, they've come up with something called the Magnificent Seven. There are 7 stocks, the biggest 7 stocks in the S&P 500, that account for all of the profits of the entire S&P 500. So if you'd owned the other 493 companies, you wouldn't have made money. It's just that these large, Apple, Meta, Google, Amazon, these companies just took off. And we're going to talk about those companies in proportion in a minute. But that's where the profits are. I would argue those are in a bubble and that's going to correct and we're going to look really good in comparison. But I don't have the track record yet of 5 or 10 years of managing your money for you to trust me. But let's just wait and see what happens. So in terms of dividends, the additional value of my portfolio was $728. We received $31,000 in dividends. That's a yield of 4.27%. The S&P 500's yield was 1.4%. So we're almost exactly 3 times the dividend of the S&P 500 with the money we've invested. That's important for those of you who might be thinking about retiring. Your dividend yield is what you're going to live on, and the higher that is, the better you'll live, right? So in terms of the business, my goal for the year was to be at $3 million under management. I'm actually at $3.2 million as of now. I have 29 accounts. It's about an average of $110,000 per account. I'm telling that so those of you who are below that number can get your act together, throw some more money. No, look, we don't have a minimum. My attitude really is, let me manage some of your money. If I do a good job, you're going to give me plenty more. If I screw it up, take your money back. I don't deserve it. I haven't earned it. I haven't had any minimum when I started. The current minimum is going to be $10,000, just because if we're smaller than that, you can't really create a portfolio. You have to buy like just a few stocks, and that makes our variances a lot higher. And I don't like that. Anybody who's already invested, I have 1 or 2 people below that number. Anyone who's already invested is fine. Your grandfather, don't worry about it. But for new people, I would probably put their minimum investment at $10,000. So,
Can I ask a question?
yep.
This is great job. When you're going back and you're comparing what you're doing versus the S&P, so what that assumes that someone is just invested in the S&P in general, but many of us, I'm not an investor, I don't know what I'm looking at, I could be in all kinds of crazy kind of things that aren't working. So you're comparing yourself against the average, but many of us could be below the average.
Right. Yeah, I'm protecting you from your own mistakes, in theory. But you would also be protected from those mistakes if you just said, I'm just going to buy the S&P and forget it. The truth is, not many people do that. Most people put a third into the S&P, and then their uncle tells them about a stock, so they buy some of that. Right. And we're going to have a Q&A afterwards, and I'll answer all your questions for as long as you want. No, you're good. So 22% of the money that I manage is mine. That's important because, guys, I'm pulling the same oar you guys are. If I do well, you'll do well. If I do poorly, you'll do poorly. I'm not taking very significant risks with our money because it's not your money, it's my money. And I really do care about it at least as much as you do, because only one of my investors has more money invested in the fund than I do. So all of that's cute, all of that's important, but it's not really important. What's really important is that what you should be measuring me on is my work product. The results that I get aren't really in my control. I can go buy a great company, and that company could go down. It doesn't mean it's a bad company, it just means it's not popular with the stock market. Warren Buffett says in the short term, the stock market is a popularity contest. In the long term, it's a weighing machine. And the long term is measured in 2 or 3 years. So what I think you should be measuring me on is my work product. And my work product is how many companies am I analyzing and how thoroughly am I analyzing them. So in 2023, I analyzed 527 countries, 527 companies. It's about 1.4 per day. I did 278 in the first half and 249 in the second half. Now, I want to explain that. When I analyze a company, that means I found a company that I was interested in, I looked at their financials, probably spent half an hour to 45 minutes on it. Most of those companies, 85% of the time, the company's garbage and I'm not interested in it anymore. Occasionally, 15% of the time, I go, oh, this is pretty sexy, I like this company. And then I really start to roll up my sleeves and I'll read the annual reports and I'll go back and try and understand who's on the board and how much they're getting paid and who the CEO is and how long he's been there and where did he go to school and what boards does he serve on. And I'll try and figure out who's buying back stock and who's selling stock that's on the board. What's the product mix? What's going on in the industry? I'll give a quick example. I found a company called Cal-Maine. Cal-Maine makes 20% of America's eggs. And they have fantastic economics. It's cheap, it's a good company, and I really like the company. Well, now I have to become sort of an expert in the egg making industry. And it turns out I don't know much about eggs, right? Well, it also turns out, as I'm doing my research, that I find out there's a bird flu, avian flu, I guess, that's killing all these chickens. And that's why the stock is so cheap, because they've got like 2 million chickens die. Well, now we have to figure out how long does it take to replace a egg-laying chicken with a new egg-laying chicken, and what's that cost? And I find this stuff fascinating because it's like a puzzle. And by the way, you'll know we haven't bought Cal-Maine Foods yet because I'm still figuring it out. But that's the kind of stuff that I'm doing, but I'm only doing that on a few of the companies. Most of these 527 companies are just companies I did the initial research on that I got exposed to. I just bought a Lovesac for my house, a new couch for the theater room. And I think the couch is great. I think the business model is pretty good. So I went and analyzed the company. I didn't like the economics. I'm done with it, right? My database, going back quite a ways, includes 1,232 companies. That's companies that I've analyzed. We lose about 50 or 75 companies a year. They go out of business, they merge, they get bought out, they go private, whatever happens, they disappear. So it's kind of a constant, kind of 2 steps forward, 1 step back. Of those 1,232 companies, only 180 of them are economically sound enough that I would like to own them for a long period of time. Of those, only 41 of them are currently both a good enough company and cheap enough that I think they're a good investment today. And we own 20 of them. So we own about 1.6% of the companies that I've looked at. We really do go through a really significant filter to get down to those companies. And those of you who spent a lot of time with me, Chris and others, are so sick of hearing me talk about these companies that I just found. But I just think it's fascinating. So that's basically my work product. You should be measuring me by this. Am I continuing to grind and look at companies? Am I continuing to be excited about the companies that I find? Am I expanding the universe of companies that might one day be good enough for us? And am I doing the homework to figure out which of those companies we should buy? The other thing you need to realize is that oftentimes when I find a company, I'm looking at it really long term. And so it may not be a company that's going to earn a profit right away. One example is we own a company called Waco, and Waco makes men's shoes. And when I looked at Waco, the financials are great, the fundamentals are good, the sales were way down because of COVID. No one's dressing anymore, so men aren't buying men's shoes anymore. Well, my logic was that's a short-term thing. Eventually, people are going to have to start buying shoes again. The shoes they own are going to start getting worn out. I'll buy it now while it's cheap, and if it takes 2 or 3 years to come back, I don't care. I'm prepared to wait that, because if I've constantly got a company that's 2 years out, and then 3 months later, I've got a company that's 1.5 years out, and 1 year out, in the long run, they'll all turn around, and they'll all get us the returns we're looking for. So one of the advantages to me being patient is that I'm not looking for something that's going to make me money in the next 30 days. In fact, I would say to you that most of the companies I buy will go down when I initially buy them, because whatever the news is that's made it come onto my radar screen has caused the price to drop, and it's unlikely that I'm going to find it the day it reaches bottom. So I'm not even bothered when they go down when we initially buy them. So now we're going to talk about doing some comparisons. When we compare to the S&P 500, what you have to understand is that the 500 largest companies in America, they are not equally weighted. So it's not, each of the companies doesn't have an equal influence on the S&P 500. The larger the company, the larger the influence. Microsoft is currently the largest company in the world. It has an influence of just under 7% of the entire S&P 500. The smallest company is like 1/100th%. The 20 largest companies in the S&P 500 are 42% of the S&P 500, and the bottom 100 are less than 10%. And so while people think they're buying the S&P 500, they're really not, because the bottom half of the companies are so irrelevant that they're not important. It's just for show. And so that's why when you see the top 7 or 8 companies performing so well, they can skew everything because those companies are a third of the entire market, even though there's only 7 or 8 of them. So what I want to do is talk about our portfolio and compare it to the S&P 500. So on the left are our companies, and on the right are the 20 largest companies in the S&P 500. And what we're looking at here is the PE ratio for those companies. The PE ratio is a shorthand that investors use to figure out how expensive that stock is relative to other stocks. If one company makes $1 billion and the other company makes $100, how do you figure out which of those is a good deal? Well, you look at the price of the stock relative to the earnings. So if a company makes $1 million and you could buy the whole company for $10 million, the PE ratio, the price of the stock, is 10 times the earnings. The lower the PE, the more the company is on sale. The higher the PE, the more the company is really popular with the market, but you're paying a very significant premium for the exact same amount of income. So generally speaking, you want to look for low PE companies. Now, there are some people who disagree with that. There's some people who think you want to buy the highest companies because those are the ones that are going up the fastest. and they're sort of right. The problem is I don't know when they're going to stop going up. So I'd rather buy the companies that are cheap because they can only go in one direction, right? So when you look at these companies, you can see that the most expensive company in the S&P 500 is Eli Lilly at 116 times earnings. Our most expensive company is 23 times earnings. You know, there are 6 or 7 companies over 50 times earnings in the S&P 500. There is only one company we own over 20 times earnings. The average earnings, the average PE ratio for my stocks is 11.9, so let's call it 12 times earnings. And the average PE ratio for the S&P 500 is 40 times earnings. I'm telling you 40 times earnings is unsustainable. If you go back and look and say how many times have the earnings of the S&P 500 been 40 times earnings and it was the same or higher in 2 years, it's 0. It's just not a sustainable number. It's too much money to pay for the value that for the income that the company is able to create. Our companies are trading effectively for 1/4 the price. And again, these are not just random companies. These are companies that I'm telling you are in the top 15% of all companies that I look at. So if you looked at through that prism, you'll say, okay, these companies are, hopefully you'll agree, are pretty cheap, especially when I tell you that if you look at the ratings I would give our 20 companies, they're significantly higher than the ratings I would give the S&P 500. So let's look at it through a different prism. This is looking at yield. So yield is the dividends the company pays, right? So the higher the dividend, the better. Well, let's look at the dividends that are being paid by the S&P 500. You know, 5 or 6 of them pay no dividends whatsoever. The highest dividend being paid by any of these companies is Exxon at 3.8%. The average is 1.2%. Compare that to our companies. You know, we have companies that are paying over 8% dividends. We have, by the way, one of our companies that pays 0 is Berkshire Hathaway. I don't mind that company paying no dividends because Warren's taking care of investing that money for me. But basically, again, we're paying 3.45% in our dividends, and the S&P 500's getting 1.2%. So we're buying these stocks at 1/4 the price of the S&P 500, and we're getting a dividend yield of almost 3 times as much. Another thing to think about when you look at these stocks is debt. So it's hard to compare debt with 2 different companies. So what I've done here is I've said, how many months of income would it take the company to pay off the debt for this company? So Mercedes-Benz is our worst company. It would take 64 months for Mercedes-Benz to pay off its debt if they took 100% of their profits and paid them against debt. Compare that to JP Morgan Chase for the S&P 500 at 144 times earnings. Amazon, 84 months to pay off their debt. Costco, 18 months to pay off our debt. So again, the S&P 500 averages 31 months to pay off their debt. We average 12 months to pay off our debt. The average company we own could pay off 100% of its debt in 12 months. We have at least 6 companies who could pay off all their debt, who have no debt whatsoever, and another 6 or 7 that could pay it off in less than a year. So our companies are significantly less indebted. They pay many multiples of earnings, of dividends, and we're buying them significantly cheaper. And what I'm telling you is I could do this analysis in category after category after category, and we're going to outperform the top 20 companies in the S&P 500. That doesn't mean we're necessarily better companies than all of those. There are some really good companies in the S&P 500. I mean, Home Depot is a solid company, right? Johnson & Johnson are great companies. They're also really expensive because everyone in the world knows who Johnson & Johnson is. Everyone in the world knows who Home Depot is. There aren't many people who know what Encore Wire is or Marine Products. And so that's one of the advantages that we have is we're able to find these small companies that Wall Street's just not looking at. So again, our stocks, the ones we've selected, they beat the S&P 500 on PE ratio, they beat the S&P 500 on debt as a percentage of as it related to earnings, and they beat it in terms of dividend yield. So finally, I want to talk about my goals for 2024. I'd like to have $7 million under management. I'd like to have 50 total accounts. That means the average account 140. So again, you guys need to step it up, some of you. My goal is to analyze 540 companies. My goal is to outperform the S&P 500 by 5%, which I've been able to do in the last 24 months, 36 months, and 48 months. There's no reason I can't do it again. I actually think it's going to be easier to outperform the S&P 500 because I think those top 20 companies are going to really underperform next year because they're so expensive. So that's it for the presentation. What I'm going to do is have the gauchos come in and start giving you guys your food, and then we'll start doing some Q&A after you guys have had a chance to stop hearing me talk for a few minutes.
Beautiful. Thanks, Jack.